Tony Nash, how are you doing? Thank you
Tracy,
so
I'm
much
good,
for
thank you. How are
joining
you?
us again.
It's an exciting day.
Good. It is. So let's just start. You thought May cuts, or we're cheering for it. I don't know. So I want to get your kind of thought on the announcement, and what's kind of your immediate assessment of this decision.
Yeah, obviously NASDAQ investors were thinking the same thing I was thinking, right? I mean, if you look at that reaction and just wait until Powell starts talking. I mean, he's a private equity guy, right? So he's going to flub it. He always screws up the Q&A. Other Fed governors always have to come in the week after and fix his statements because he always goes overboard one way or another. And so the fact that they're not saying that they're considering being more dovish in their formal statement, if he doesn't signal that in his remarks, then I think tomorrow we're going to have a rough day because if you look at where we are today, inflation is in a much better place than it was in Q3 and Q4 when there were cuts. Employment is around the same place. And the statements that the Fed makes about inflation, my question is where? Okay, so a couple months ago, everyone was talking about egg prices. Egg prices are now down to reasonable levels, right? We have crude because of the OPEC Plus meeting over the weekend. Energy prices are falling dramatically. Because of trade, we have things like proteins like beef and pork and chicken, our vegetables, other things in the U.S. Those prices are going to come down. Housing and rents have come down, right? So I'm wondering, aside from, say, electronics and cars, which aren't small, but where is this inflation that the Fed is talking about, and where is it going to come from? Because when we look at the things that are the biggest wallet share of Americans, it's just not real and it's just not happening. And I think, people really need to push back on the Fed and say, is the inflation in the room with you now, right? Like it's just this made up thing that people are expecting, and it's just not real at this point, nor is it going to be real in the next couple months.
So do you not buy kind of that narrative that's being pushed everywhere, particularly on X, where we're going to have empty shelves and the ports are empty, which the ports aren't empty. I talked to Ross
They're
the
not
other day,
empty.
but
No. Right.
this is, what's going on is that, this is what's going to push prices higher because we're going to have shortages, and things of that nature.
Yeah. So the Fed is always fighting the last war, right? And so what did we see in COVID? The last war was COVID. We had toilet paper shortages. That was because of domestic processing plants. That was not because of international trade. Okay. So for people watching who don't know, all of your paper products are made locally. They're made regionally around your state and your city. 90% of those are not imported products. So you're not going to have to stock up on toilet paper or paper towels or any of that stuff. Most of your food is from inside the US and processed inside the US. So, are there going to be shortages on shelves? Yeah, maybe if you want a new TV, there might be. But in Q1, we had so much inventory stocking that I can't see that playing out before, say, August or September, right? So again, as you said, Tracy, we've seen this narrative of shortages, especially over the last, say, 2 to 3 weeks. And my question to those guys is what are we going to be short of? I need them to name what we'll be short of and what the urgency is. So both shortages and inflation, the question remains, what is it? What is the inflation that's coming?
Right. And so given the decision, no cut today, do you see any significant long-term impacts for any key sectors, for instance, housing, tech, or manufacturing over, say, the next 12 to 18 months?
Yeah, I think so. I had about a 35% likelihood that the Fed would cut today. So I didn't have it at the 3% that most people had it. I thought that there was a possibility, but not a likelihood that it would happen. I think it would be right to lean dovish in this meeting and then cut in the next meeting. Because what will happen is this. Things like housing, people will put off housing purchases because there's an expectation that the Fed is going to cut in the summer. So if you buy a house now, unless you absolutely have to, you're kind of dumb because in 2 months, your rate will be lower, right? And in 3 months, it will be even lower. And so you start to get that arbitrage on large purchases, given where we are in the cycle. So if the Fed had signaled dovishness coming, then you would see long rates relent a little bit, right? And then people wouldn't be punished for taking out loans now. They would be rewarded a little bit because those yields would come off a bit. But what's going to happen is people are going to put off those large purchases for 2 to 3 months. So it's really going to hurt the backside of Q2 in terms of the U.S. economy.
Well, and given that the next Fed meeting isn't for 2 months, so in between, a lot can happen in two months, right? And so
Right.
we're going to get 2 CPIs, we're going to get 2 everything. Is there a chance that the data deteriorates so much that then they become behind the curve?
Well, there's a possibility, but I think, if you look at things like CPI, I think it's possible that the CPI goes well below 2 in the next couple of months. And then, if you have labor where it is now and you have inflation falling pretty dramatically, because again, we're not exporting as much ag as we did because these other countries are saying we don't want it because of the trade war, right? So we have beef and chicken and pork and soy and all these things captive in the U.S. economy. So that'll push down prices on supply in the U.S. And so we'll start to see those prices go down. And, the problem with them not leaning dovish today is that they may have to put out a statement sometime in June to underscore the fact that they're not completely out of touch, and almost guarantee a cut in July. Because again, they look really out of touch and they're very academic, the economists at the Fed. They don't really get out of their neighborhood, their plush neighborhood, and see what real people are doing. And so they're really disconnected from the way the U.S. consumer behaves and the way U.S. industry behaves.
Do you think there's a chance that Powell didn't cut because he was so pressured by the administration he didn't want to seem political?
Oh, I think he didn't cut because it's political. I think, remember, there were cuts in Q3 and Q4 when inflation was even higher. Okay. There were cuts in Q3 and Q4 when the labor market was even better. So those cuts were very political, and this lack of a cut is very political. So I believe that Powell is trying to embarrass the administration for political purposes, of course, because now they wait for 2 months, right? And now, you could have a Q2 GDP print that is much lower than expected because, again, people are putting off those large purchases. So, I expect people to look at this and go, wow, this was a huge mistake, just not even leaning dovish in their statement. And it's really going to damage the economic performance in Q2 because he didn't even lean toward dovish, which would have a serious push downward on long yields. So that's the real question, is long yields. What happens with long yields? And so if Powell is making dovish statements, then that makes Bessent's job easier in terms of pulling long yields down. And that's one of the biggest challenges of the Treasury right now, is figuring out how to get those long yields back down so that we can get some tailwinds in real estate.
Absolutely. And the minister, Bessent hasn't been quiet about that fact either, that, he wants yields down, Trump as well. Did you by chance get a chance to read that statement? The Fed
I
statement?
saw it a little bit. It was really pretty neutral, right? I mean, there weren't any major changes. And they talked about the possibility of inflation. So, they're talking about the fact that inflation at the rate of 2%, it hasn't quite hit 2% yet. But, what they disregard is kind of inertia or momentum in markets, right? So we have this momentum toward 2%. And if they wait too long, it's going to overshoot. And, I think they've waited too long. They started rate cuts in the fall, and then they stopped. And they should have continued with another 25 this month. I think they should have continued with another 25 this month to continue the course that they had started. They wouldn't have done it too soon, I think. I think they could have looked political if they had done it too soon. They waited a little bit. I think it would have been a good time.
And then considering kind of the global economic landscape, we have global geopolitical tensions, supply chain considerations, et cetera. And then we have inflation, and then we have every other central bank cutting. How
Right.
does the Fed's decision today, where does that put us?
Yeah, well, the real problem is the upward pressure it'll put on the dollar, right? You see you mentioned the yen moving, right? So the yen is appreciating because Japan is pretty dovish generally, and the euro, the ECB is very dovish. The PCOB in China is very dovish. They have to be. So, the upward pressure on the dollar will be real. That will hurt the trade balance of the U.S. of where the administration is trying to go. So the Treasury then will undertake activities to weaken the dollar. So you're going to see, this environment where the Fed and the Treasury are working against each other in order to have a dollar in the, say, mid to high 90s on the DX. Because the administration does not want, we had a DX around 110 or so when Yellen was in office, and that was too powerful. It was hurting our trade partners in terms of their debt commitments and debt repayment. It was helping them in terms of their trade balance, but it was hurting them in terms of being able to service their debt.
Well, this isn't new, right? We had Yellen and Powell kind of on opposite ends of the spectrum as well.
Well, they were,
Do
but
you
they
think that
weren't,
that's
right? I mean, they were
intentional?
complementing each other. Yeah, they were complementing each other. In many ways, they were. And so, we had a very strong dollar in 22, 23. And yeah, they were going in separate directions, but between rates and the dollar, it was attracting more investment in the US. And that's really what was pushing the dollar up, as well as some of the Treasury policy. But for the past year, almost 2 years, the Fed and the Treasury had been going in the same direction. And remember, when Yellen was the Fed chair, she would complain again and again about how she was doing the monetary actions, but no fiscal actions were taken. And so when she took over the Treasury, she did crazy fiscal actions to kind of reinforce the monetary actions that were taking place. So she was very fiscally active. And so you don't get that with Besant or with Besant. I mean, he really is going to make sure that the U.S. is very careful with its spending. At least that's what he's going to vocalize. And again, there's going to be a lot of pressure on the Fed to ease because you're not going to have the fiscal activity that you've had over the last 4 years.
Now, I kind of want to switch to kind of look at businesses, particularly small
Sure.
businesses. As you know, you're in that business. So,
Yes.
how are businesses trying to navigate kind of this environment right now? And what's the single most important forward-looking advice you can kind of offer in light of this rate decision?
Yeah. Money is tight for small businesses and margins are tight. And as we have these costs, at least these domestic costs inputs go down, of course, international cost inputs will be rising because the dollar is weak and tariffs, right? So Small businesses that import are seeing serious margin compression, and you still have pressure on the staffing side. So, it's very tough. And so, again, this is where my expectation was that the Fed would lean dovish because small and medium businesses need easier credit conditions. Without the Fed moving, small and medium businesses are going to have a really hard time. This is good for big businesses because they want the small guys to go out of business. But for the small and mid-sized business, I mean, Carol Roth, she's always advocating for small businesses, and I love that. But those small businesses are facing serious cash flow issues because of rates and because of costs and because of staffing costs. So they're having a really hard time. And this isn't something brought on by them, it's brought on by external factors.
Right. And so do you think the Fed takes this into consideration at all? I know their mandate
Absolutely
is,
not. I don't think the Fed cares. The Fed doesn't care about small businesses and they don't care about consumers. They care about banks and they care about big business. That's all they care about.
which seems at odd with their maximum employment mandate. But
Yeah.
so kind of looking ahead for the next few FOMC meetings, what key economic factors are you going to be closely watching to anticipate the Fed's next move, and kind of what is your baseline expectation for the path of interest rates through the end of the year?
Yeah, I would expect a cut in July. I think it's going to be overdue. I think by the time July comes around, people are going to be screaming for a cut. We will have imported inflation. Now, keep in mind, when I say imported inflation, that means that prices will, because China exports deflation, right? So what we import from China is below what a market would produce on its own. So because we're normalizing the cost of goods that come out of China, it's going to be inflationary simply because China overproduces. So we're going to see those imported prices normalize on a higher rate. So that's going to be seen as inflationary, which it is. We're going to see domestic goods, especially agriculture and other goods, paper goods, these sorts of things, fall in price over the next couple of months. And so depending on the sector, you're going to see margin compression. But in some sectors, like say electronics or something, you may actually see prices rise and you may see margins widen out in areas like electronics, where we may by August have a smaller supply of those goods, leaving those electronic sellers to charge more for those goods based on shortages or whatever. But for those domestic industries, there's going to be a lot of pressure on them in terms of margins. So I would expect a cut in July, and then maybe one in September, October, and then one in November, December. So I would guess 3 to 4 cuts this year. But again, I believe they're late because small and medium businesses are suffering cash flow issues.
And they always are behind the ball. That
Always.
is right. So and then, anything else that you would like to add, some final words, and before we leave, what you kind of expect, the markets to look like?
Tracy, I think what's really interesting is the OPEC decision over the weekend, and I know you've probably talked that to death by now, but I think that's a deflationary move globally for everybody. And when we look at the dollar, which was moving lower, and the OPEC decision over the weekend, because oil is priced in dollars, that was a price cut for everyone globally. So I think, again, we need to hear the Fed make dovish moves so that the dollar continues to weaken slightly, so that the world can have a price cut for energy, which will have secondary and tertiary impacts on everything that we do.
Absolutely. And with that, Tony Nash, thank you so much.
Thanks, Tracy.
We'll definitely have you back.
Thank you.